Let's get right to Gregory Peters. Greg, good morning.
Hey, Tom, how are you?
Is inflation back? I mean, I'm loving this. Prices paid, up it goes, up, and yet Bernanke says there's no inflation. Who's right?
Well, look, I mean, I think inflation is definitely on the rise. It's one of our biggest concerns. I would say at Morgan Stanley, where we're different from the consensus, is that we're much more fearful about inflation. So that's something that we totally worry about.
Cardinal rule in the business, folks. It's about time to learn about forecasting, and Gregory Peters knows this. The moment you make a major call and you reverse it is when it happens. It's always the case. Reminds me of Jeff Vinnick and George Vanderheiden at Fidelity a million years ago. You weren't born, Greg. But when you look at this, Greg, Morgan Stanley had a higher rate call. Yeah. You know, you capitulated in a sense and said, yeah, but when do we see your higher rate call? Is that for this year, or do we see that in 2012?
No, look, our call is for higher rates. We expect the curve to steepen out. So where inflation will manifest itself in the U.S. Treasury curve is the back end. So you have QE2 ending in June. You have inflation, I think, on the rise. You have a little growth. Yet the Fed has said, Tom, as you mentioned, they're not going to move anytime soon. So I expect, or we at Morgan Stanley expect rates to move higher, not dramatically, not the 5.5% like we called last year, but I think the trend is towards higher rates, and I think that's the reality of the situation.
Dreaded first chart. Let's look at it, folks. It is dreaded. Core CPI ignores commodities. I mean, Greg Peters, help me out here. Core CPI, nobody has that in their grocery bag. Nobody has that in their college tuitions. Nobody has that at home. Can the commodity inflation and the business inflation that we saw today in ISM prices paid, can that leak into core CPI?
Yes, eventually. It's slow. You know, it doesn't happen immediately. As you know, CPI is being pulled down or at least moderated by what's happening in housing, which is still a drag here in the U.S. But I think, or we think at Morgan Stanley, that the commodity inflation, not only in energy prices but in food, ultimately flow through into the core numbers.
Let's look at a flow through. Let's do an elegant chart one here, folks. Let's bring up the first chart. And this is a chart we've played before, Greg Peters, on China and inflation. There it is. And, Greg, it shows the booming chart, China CPI, and beneath it, a regular CPI. Those are mislabeled. The white one is regular CPI, and the red one is the food inflation. What do you take away from China, Greg Peters, as we look at inflation in the United States and the rest of the world?
Well, it's about food. Once again, food inflation, is a bigger concern in the emerging world than it is in the U.S. So, for example, in emerging markets, it's about 25% of CPI. In the U.S., it's a fraction of that. So it's not nearly the same kind of problem. But nonetheless, it does ultimately feed back into the U.S. So what that could mean is that higher wages in China, as an example, which means that we import higher priced goods into the U.S. So It flows through. It's all connected, Tom.
I agree with that. It's all connected, fine. But the fact is we're seeing these business statistics suggest inflation. Michael McKee will be on later with some of the background on that. How can a central bank ignore that?
Well, look, what the central bank is worried about right now is to make sure that the U.S. is still on the proper growth path. And so at the end of the day, if you look at the core CPI numbers that you just mentioned, it's still at a level that's not of concern. And even the Fed forecast themselves doesn't get to a high level of concern. So what they're worried about, the clear and present danger for the Fed currently, is to make sure that the U.S. economy is on a sustainable growth path. And look, there's a big test in the second half of this year with the U.S. coming off of QE2.
How do you define a sustainable growth path? Is it an output gap reduction? Is it persistency of a robust GDP? How does Greg Peters define sustainability here?
Well, it's a combination of a couple different things, but I think persistency of GDP growth. So there's a lot of skepticism amongst investors about the sustainability of U.S. growth. Is it fact or is it fiction? Is it just pure stimulus, or can it stand on its own? And so I think we'll get a better read on that in the second half. And I think the Fed is worried about that ultimately. And so they're not going to pull the trigger about future inflation fears unless they really feel like the U.S. economy is on a sustained growth path on its own.
To push back against Ben Bernanke, and there's any number of economists talking about this, what would happen, Greg Peters, if they raised the target rate? Remember that, folks, the target rate. This is like old news from 3 years ago. What if they raised the target rate 25 or 50 or even up to 1%? I mean, what if they just nudged it up a little bit?
Look, I mean, at the end of the day, it's not a big move, obviously, right? But I think the optics of it and the direction of it. So what investors look at is that they typically don't see one move. And so once you see one move, you see several moves. And so the market will price in a lot more. Right. And that's something that could have a real growth impact.
Doug Cliggott, let me go to you, and I want you to bring up right away too much information. Here we are, Doug Cliggott. We talked to Greg earlier about inflation, and you see it in the indicator like ISM prices paid today. Here it is, folks, the whisper of inflation ahead. And I don't like to put these charts up because they're sort of ugly, squiggly, but you can see how we drive up there. We drive up recently on ISM prices paid. Doug Cliggott, is inflation back?
In some sectors, it sure is, Tom. And I think I heard Greg earlier. Everything's really connected here. You were focusing on the powerful increases in food and energy inflation, especially in developing markets, much bigger share of the consumption basket there. We think that's flowing back and influencing the U.S. equity market. And I'll connect the dots. You've really got, I think, open-ended monetary policy tightening now in China, in Brazil, in India. All of these countries need to try to slow down their rate of growth and inflation. That's been a huge source of demand for basic materials and a big driver of great performance of basic materials stocks in the U.S. in the last 2 years. Suddenly here in January, basic materials are underperforming. And so that's one way we're trying to connect the inflation dots.
Let's connect the dots here, Gregory Peters. Spreads widen on, excuse me, folks, it's a plague from Switzerland. I'm scratching the top of my head. Spreads widen on inflation, Greg Peters. 2s, 10s. First of all, clinic. Greg Peters, explain this. Why do we look at the 2s, 10s spread?
Me. Okay. So, no, because I think that is really what's telling you what the future expectations are. And it's getting harder and harder to do that, though, Tom, because of QE2. So once that gets out of the way, or the market starts pricing that out of the way, then I think you'll see that curve steepen even more. But there's not a lot of places on the yield curve where inflation expectations can manifest, right? If the Fed is coming in and buying 10 years, as an example, there's a natural ceiling on where yields can go, I think. So I think we'll get a truer sense of the picture in the second half of this year.
Doug Cliggott, if we get Peters widening of the curve, let's say we go record wide 300 beeps plus, is that good for equities?
It's good for some equities, Tom. It's less good for others. I mean, when we look domestically, we see two price trends that are actually working against profit margins. In December, we saw private sector compensation was now up 4.1% versus a year ago. Intermediate goods inflation is 6.5%, 6.6%. And so what we're really hunting for in the equity market now are industry groups, sectors that can absorb those kinds of labor cost increases or don't have much in the way of intermediate cost increases. And you were talking about free cash flow earlier. A favorite of ours is software, where tons of free cash flow, not really affected by this real acceleration of intermediate goods prices.
When you look, Greg Peters, at all of this, where do you hide on the yield curve? Where do you hide in the bond market? Bill Gross says lighten up on bonds. Margie Patel says lighten up on bonds. Where does Gregory Peters hide if I do want to make a coupon?
Look, I think the market still is pretty good in spread product. So, I mean, companies, corporate America, for example, is still in very good shape. We expect credit spreads to tighten. Still like high yield. It's not nearly as attractive as it once was. But what we like, playing this inflation theme more than anything else, is actually the emerging market currencies. So I think that is one of our favorite trades out there currently.
Well, which one? The Egyptian pound? Greg Peters, let's make some headlines here. It's a break exclusive. Greg Peters is long the Egyptian pound. Well, I'm kidding. No, but what do you like?
No, so I mean, we like the Mex peso, for example. The Malaysia ringgit are what a couple, but I think that's how you want to play this inflation cycle. The bond market's getting trickier, so I think an easier way is through a lot of these emerging market currencies where inflation's going to rise, policy has to combat it, and that'll flow through into these currencies.
Well, let's look at this chart, Doug Cliggott. It's a Gregory Peters chart. It's the BAA industrial to the 10-year, and boy, it's come in a line there, folks. Brings normalcy to the market where the BAA yield and the 10-year are closer together. Doug Cliggott, what does it signal to you to see quiescence in the spread market?
Well, I think it's an indication, Tom, of really a theme you've focused on for quite a while, how tremendously good health a lot of U.S. corporate balance sheets are in. A lot of cash, paying down debt, just phenomenally healthy balance sheets. And again, in some sense, early in the cycle, when balance sheets are more iffy, that gives you one tone to the equity market. You want to buy low quality that's going to improve. When we're this far advanced in a cycle where there really isn't a lot more improvement left, or if there is, it's marginal, you tend to see the market gravitate towards higher quality, very large cap stocks. And that's where we think we are now in sort of year 3 of the cycle.
Let's circle back here, Greg Peters, in the time we've got left with you. We'll have Doug Cliggott follow on with this, folks. Here is a U.S. output gap. This is the challenge that Ben Bernanke has. And Greg Peters, you alluded to this before. We're such a long ways away. That chart goes out to like 2012-13, the OECD forecast built in there. Greg Peters, this sounds like a big free lunch. We have a monetary policy, and we're on script, and as both of you know, it never works out that way. What is the surprise you're looking for, Gregory Peters, when you see the output gap where it is? We got a Fed in play, and yet we got this inflation data. What's the surprise you're worried about out there?
Well, gosh, where do I start? There's more surprises to worry about today than in a very long time, oddly enough. But I think from an output gap perspective, I think what a surprise could be is that actually narrows more than is anticipated. So, a lot of this is going to get pulled forward from the CapEx cycle. Jobs typically follow that, and so you could see a broader economic improvement, much more than I think is anticipated by many investors. I think that's a surprise that no one wants to talk about. For example, 6 months ago, we had this potential outcome of Morning in America, we called it, where basically the U.S. actually grows more strongly above this new normal, and no one wanted to hear it.
Doug Cliggott, it's our note of the day. Let's bring it up here, folks. Anytime Douglas Cliggott writes, it is a note of the day. Doug Cliggott, better than bonds. We continue to view 4.4% dividend yield favorably, and we do not believe the risk-reward profile of the 10-year is very attractive. If you're going to try for 4.4% yield, Doug Cliggott, where do you do it?
You do it, we think, in a basket of very large cap U.S. equities. We've selected a basket, Tom, that you're looking at that has relatively low beta, so the stocks move around less than the broader market, have high quality balance sheets, and collectively have a dividend yield that's well over 4%. So, for those investors seeking low volatility and yield, we actually think large cap U.S. equities are a better place to do it than the government bond market now.
And everybody's technology, energy, hydrocarbons. I sound like Pim Fox. Let's get old fogey here, Doug Cliggott. Utilities. Con Ed lost in a snowdrift here in snowy New York. Con Ed, better than bonds. Con Ed, I was surprised, Doug Cliggott, really back to Dow 14,000 peaks. Why Con Ed right now?
Well, we come up with that basket of stock, Toms, just by screening the S&P 500 by different criteria. Yield criteria, again, the beta volatility criteria, balance sheet criteria, and we just take what that screen puts out. But the basic concept, and we wouldn't recommend this for your entire equity portfolio, But for that part of your portfolio where you're yield-oriented, don't want a lot of volatility, that's where we would focus. Other parts of your portfolio, you can have a little bit more risk, some of the more growthy parts of the market.
Growthy.
What we're trying to signal there, though, Tom, really is there's risk in the bond market at these yield levels.
Right. Jargon alert. Doug Cliggott, growthy. Let me clear up growthy. It's like growthiness. It's a little less than growthiness. Doug Cliggott, let's bring up this chart. This is clinic time. We normalized Pfizer and Colgate. It's an elegant chart. No, that's not it. That's Con Ed. We're waiting for the elegant chart here. The gerbils are working back. There it is. It's gorgeous. Pfizer, the white lines down. Ugly. Colgate up. Everybody's in love with Doug Cliggott's free cash flow. Doug Cliggott, how do you sort out the winners like Colgate from the dogs like Pfizer?
Well, that's why you build a portfolio, Tom. I'm not trying to be cute. You can't be right every time. I'm absolutely positively not right every time. What you do is you have a discipline, you look for certain metrics, and you have to be patient. Over time, we think these metrics will work for you, but in any 3-month, 6-month time period, it's every stock isn't going to work.